If you want to learn how to trade options but don't want to risk a lot of money and don't know how to get started, then this video is for you. I will explain how options work in the simplest terms and then show you exactly how to trade them on Robinhood. So let's get started. There are two types of options, a call and a put. If you think the stock price is going to go up, buy a call option. And if you think the stock price is going to go down, buy a put option. So let's talk about what exactly a call option is. Imagine that you want to buy 100 shares of XYZ that is trading at $120. You would need $12,000, and if XYZ goes down to 110, you would be losing $1,000. But if XYZ goes up to $130, you would be making $1,000 in profit. So in this situation, you can use a call option as a leverage. So a call option is a contract between the buyer and a seller, where the buyer has the right to buy 100 shares of a given stock by a set expiration for a given strike price. I know that's a lot, so let me break down the definition. So expiration date is the date when this contract expires. Strike price is the price at which you can buy the 100 shares of that stock. And the premium is the price you pay to own that contract. So now let's take a look at an example. So you could buy a call option for XYZ for $200 that has an expiration of next week with a strike price of 120. So if XYZ closes at 130, well, good for you, because now you can buy 100 shares of XYZ at 120. So that would mean that your profit is $1,000, well, minus the 200 premium that you paid. So your net profit is $800. But let's say that XYZ closes at 115. Well, then you don't have to exercise your option. If you don't exercise your option, you don't have to buy the 100 shares. So all you would lose is the $200 of premium that you paid. Now, before we jump into Robinhood, I think it's important to note that most people who trade options don't really exercise their contracts. Typically, you would buy a call option, and if the underlying stock goes up, the value of the premium would go up with it, and you could sell that contract to someone else for profit. And if the underlying stock goes down, the value of your premium would go down, and you could sell the contract for a loss, or you could let it expire worthless, which means the value of the premium goes down to zero, and you take the entire loss. So let's go to Robinhood and buy a call option for Apple. So go to search and type in Apple. And then from this page, you want to click on trade options. Now, what you're looking at is called the options change. First, you want to make sure that you're on the buy and call tab. Ignore the sell and the put tabs. Now, most stocks generally have options that are traded on a weekly basis, so they expire on Fridays. If you're starting off, make sure you buy an option that is at least 1 to 2 weeks out. This is important because option contracts lose a lot of value very rapidly as the expiration date approaches. So let's choose February 4th for Apple. So the left column shows the strike price and the rightmost column shows the contract premium. Since each contract controls 100 shares, you would multiply the premium by 100. So for example, this contract with a premium of $3.25 means that it's worth $325. Now, since Apple is trading at $170, contracts with a strike price under 170 are called in the money. Contracts with a strike price above 170 are called out of the money. And contract with the strike price of 170 is called at the money. General rule of thumb is that in-the-money contracts are safer and they cost more. Out-of-the-money options are riskier, but they are cheaper. So if you're new, try to stick with in-the-money contracts. We're going to add this at-the-money contract with a strike price of $170 for $325. On the right, you will see a profit and loss chart. As you can see, since we're paying $3.25 per share for this contract, our break-even price is $173.25, which means we make profit once Apple crosses 173.25, or gains 1.63%. Since you wouldn't be exercising this contract, the break-even price doesn't really matter. But what matters is the percentage change column. So this contract has gained 175.42% today. In other words, this contract has gained $207 in value. This means that this contract was worth $118 yesterday, but it's worth $207 today. So imagine you bought 10 contracts yesterday for $11.80 and selling them for $32.50. That's $2,070 of profit in a single day. This is why a lot of people trade options, because of how much leverage you have since you're controlling 100 shares. But remember that options are very volatile and it's very easy to lose all of your premium in a matter of days. So only purchase the option if you're comfortable losing the entire premium. So let's click on continue and we're going to enter 2 contracts for $325 each. So our max cost is $650, which is the maximum amount we would lose. So let's submit this order, and now this will be executed when the market opens. And that's how you buy a call option. Okay, so there's a lot we didn't cover in this video, such as how option prices work and how volatility affects the premium. This was our first YouTube video and we plan to make more videos soon. If you liked it, please give us a thumbs up and we would really appreciate your support. And don't forget to subscribe for more content like this.